the United States government owes more money than any entity in the history of human civilization. Not more than a corporation, not more than a bank, more than every country that has ever existed, combined, at any point in recorded history. And here's the part nobody wants to say out loud: it cannot pay it back. Not won't, cannot. The math doesn't work. The timeline doesn't work. The interest alone is consuming the budget faster than tax revenue can replace it. And instead of treating this like the emergency it is, the people in charge have quietly agreed across party lines, across decades, across administrations, to do the one thing that feels the least painful in the moment: keep borrowing. This is the story of the largest debt bubble in human history. How it grew, why it keeps growing, what it actually means for ordinary people, and why the reckoning, when it arrives, won't announce itself with a warning label. It never does. Let's rewind to understand how we got here. Because this didn't happen overnight. After World War II, the United States emerged as the most economically powerful country on Earth. Factories were humming. Exports were exploding. The dollar was crowned the world's reserve currency, the universal language of global trade. Other nations pegged their money to it. Oil was priced in it. Debts around the world were settled with it. That status gave America something no other country had ever been handed: the ability to borrow almost without consequence. Need to fund a war? Borrow. Need to build highways? Borrow. Need to expand healthcare entitlements? Borrow. And for a long time, borrowing made sense. The economy was growing faster than the debt. The debt was manageable relative to GDP. Interest rates were reasonable. The system held. But a quiet shift happened, slowly, then all at once. Spending grew. Tax revenues didn't keep pace. The gap between what the government collected and what it spent became structural, meaning it wasn't a temporary problem caused by a recession or a war. It was baked in, a permanent feature of the machine. And so the borrowing never stopped. Here are the numbers, because the numbers matter. U.S. national debt crossed $1 trillion in 1981. That felt enormous. Economists debated it on television. Politicians campaigned against it. It crossed $5 trillion by 1996. It crossed $10 trillion in 2008, right as the financial crisis hit, and the government decided the solution to a debt problem was more debt. Rescue packages, bailouts, stimulus. Reasonable, maybe. Necessary, arguably. But the trajectory had now shifted to something steeper. $20 trillion by 2017. $30 trillion by 2022, $35 trillion by 2024. And the projection? The Congressional Budget Office, the government's own number crunchers. Not some doomsday blog, expects the debt to hit $50 trillion within the next decade under current policy. No crisis, no major war, no catastrophe required. Just Tuesday, business as usual. The machine running exactly as designed. But here's where it stops being an abstract number and starts being a real problem. Interest. When you borrow money, you pay interest. That's obvious. What's less obvious is what happens when you borrow so much, at rising rates, that the interest itself becomes one of your largest expenses. In 2024, the United States spent more on interest payments, just the interest, not paying down any actual debt, than it spent on the entire defense budget. Let that land. More money going to bondholders, many of them foreign governments and institutions, than to the military. More money servicing old debt than building anything new. And it's accelerating. The Federal Reserve spent years keeping interest rates near zero, which made carrying the debt artificially cheap, but inflation forced rates higher. And now the government is rolling over old debt that was borrowed at 1% into new debt at 4%, 5%, even higher. The interest bill grows automatically, every year, without Congress voting on it, without anyone's approval, It just compounds. This is what a debt trap looks like from the inside. You borrow to cover spending. You borrow more to cover the interest on what you already borrowed. The hole doesn't stay the same size. It deepens. Now here's the part that doesn't make headlines, because it's uncomfortable for everyone across the political spectrum to admit. There's no realistic plan to fix this. On one side, you have those who want to cut spending. The problem is that the vast majority of the budget is locked into things that are politically untouchable: Social Security, Medicare, defense, and interest payments. What's left? The discretionary stuff, the programs politicians argue about on television, is a relatively small slice of total spending. You could eliminate it entirely, and the structural gap would barely close. On the other side, you have those who want to raise taxes. And yes, there is room to collect more revenue. But the scale of what would be needed to actually close the deficit, not just slow its growth, but reverse it, would require tax increases so large that they'd almost certainly drag on economic growth, which would reduce tax revenues, which would widen the gap again. Neither side has a clean answer, and both sides know it. So instead, they borrow more, raise the debt ceiling, kick the review to the next administration, hope the economy grows fast enough to shrink the problem relative to GDP. It's not malice. It's the path of least resistance. And the path of least resistance, held long enough, becomes the only path. You might be wondering why this hasn't exploded already. It's a fair question. People have been warning about U.S. debt for decades. They've been called alarmists. So far, the catastrophe hasn't materialized. Maybe the warnings are just noise. Here's why the disaster hasn't arrived yet, and why that doesn't mean it isn't coming. The United States controls the world's reserve currency. When things get uncertain globally, a financial crisis, a pandemic, a geopolitical shock, money flows times into times dollars and U.S. treasuries, because they're still considered the safest place on earth. Demand for U.S. debt stays high even as supply explodes. That's a privilege, a real one. But it's not a permanent law of nature. History doesn't offer many examples of reserve currency status being permanent. The British pound was once what the dollar is today. Before that, the Dutch guilder. Before that, the Spanish real. Each held the top position until it didn't. And the transition, when it came, wasn't announced with a press conference. The real risk isn't a sudden explosion, it's a slow erosion of confidence. Foreign governments gradually reducing their treasury holdings. Countries slowly settling trade in other currencies. The marginal buyer of U.S. debt demanding slightly higher rates to compensate for slightly more perceived risk. You don't see it clearly until you're already inside it. There's a behavioral element to this that rarely gets discussed, and it might be the most important part. Debt, as a concept, is psychologically invisible when it's collective. If you personally borrow $50,000 more than you earn each year, you feel it immediately. Your bank statements don't lie. The anxiety is real and daily. But when a government does it, abstracted across 330 million people, denominated in figures too large to visualize, debated in language specifically engineered to be confusing, it disappears from your awareness. It becomes background noise. A number politicians argue about that doesn't seem to touch your actual life. Until it does. Because here's how collective debt eventually reaches the individual. It shows up as inflation when borrowing is financed by money creation. Purchasing power erodes, and your groceries cost more without your paycheck keeping pace. It shows up as higher interest rates when the government competes with everyone else for borrowed capital. Rates rise and your mortgage, your car loan, your credit card balance all get more expensive. It shows up as reduced services when interest consumes the budget. The programs that were supposed to protect people quietly get squeezed. It shows up as currency debasement, slow, steady, nearly imperceptible until suddenly it isn't. The debt is abstract. The consequences aren't. Now, zoom out, because the United States isn't alone in this. Japan's debt is roughly 250% of its GDP, by most measures, the highest of any major economy in the world. They've been running enormous deficits for 30 years. The Bank of Japan has bought so much of its own government debt that it essentially owns a significant portion of its own country's financial obligations. And Japan hasn't collapsed. The yen hasn't gone to zero. The economy hasn't imploded. Why? Because Japan's debt is almost entirely held domestically. Japanese institutions and citizens own Japanese government bonds. Capital doesn't flee easily when the creditors are the same people as the citizens. The U.S. situation is different. A meaningful portion of American debt is held by foreign governments, China, Japan, oil-exporting nations. That creates a dependency that Japan doesn't face. And the U.S. also enjoys reserve currency status, which creates demand for treasuries that Japan never had. The U.S. can run higher deficits before the bond market panics, but that also means the adjustment, when it comes, could be sharper. Europe sits somewhere in the middle. Germany runs relatively tight fiscal policy. France and Italy carry heavier loads. The Eurozone experiment means that countries like Greece don't control their own monetary policy. They can't print their way out. Which is exactly why Greece's 2010 debt crisis hit so hard while others managed softer landings. The point isn't that every indebted country is about to fail. The point is that debt dynamics follow their own logic. They're forgiving for a long time, and then suddenly they're not. There's a concept economists call the fiscal dominance scenario. It's not theoretical, it's happened before. Fiscal dominance is when a government's debt obligations become so large that the central bank, whose job is supposed to be controlling inflation, loses its independence. Instead of raising rates to cool inflation, it has to keep them low because high rates would make the debt unserviceable. Inflation control gets subordinated to debt management. The result is a self-reinforcing loop. Debt stays high, rates stay suppressed. Inflation runs persistently above target. The real value of savings erodes. People on fixed incomes, the retired, the cautious, the disciplined, carry the cost of a problem they didn't create. It's not a dramatic collapse. It's a quiet redistribution. Wealth drifts from savers to borrowers, from the patient to the leveraged, from people who followed the rules to the institutions that changed them. So what does any of this mean for you? Not financial advice, not a market call, just a framework for thinking clearly. First, inflation is not a temporary glitch. When debt is this large, and the political cost of real austerity is this high, the most likely long-term pressure is toward persistent inflation. Not hyperinflation, not Weimar Germany, but the quiet, steady kind that makes $100 worth $85 in 5 years without anyone declaring an emergency. Second, cash is a losing position over long time horizons in this environment, not because markets always go up, but because the currency itself is under slow structural pressure. Third, assets that are scarce, productive, or globally valued tend to hold purchasing power better than paper promises. That's not a tip. That's just history. Fourth, the debt conversation matters more than the media treats it. When it appears on cable news, it's usually weaponized as political ammunition, rather than examined as a structural reality. Separate the noise from the math. And fifth, the people who feel this most are not the wealthy. The wealthy own assets, businesses, real estate, things that reprice with inflation. The people who feel it are those who depend on wages, savings accounts, and fixed payments. The erosion is most painful for the people least equipped to hedge against it. Here's what bothers me most about this whole story. It's not a secret. None of it is hidden. The CBO publishes the projections. The Treasury reports the interest payments. The Federal Reserve communicates the rate decisions. The data is public. The math is available. and the conclusion is not ambiguous. The debt is too large to repay in real terms. The only question is how the loss gets distributed. Inflation does it quietly, across everyone, without a vote. Default would do it loudly, catastrophically, in a way that no government would choose willingly. Sustained growth could reduce the relative burden, but would require an economic expansion that has no historical parallel. None of those paths are painless. The system is choosing the one that's least visible. And the most unsettling part isn't the debt itself. It's that the people in charge of addressing it across every administration, every Congress, every generation of policymakers for 40 years have looked at the math, understood the trajectory, and decided that dealing with it was someone else's problem. They weren't wrong, exactly. It was someone else's problem. It's yours now. The question isn't whether the bill arrives. It's what shape it takes when it does.